All right. Good morning, everybody, and happy Monday. We are set to get started here in just a minute. Hope you guys can hear me okay. Going to be a busy week this week with CPI and a lot of headlines, and I think we're getting closer to a potential oversold bounce in U.S. equities, right? Remember, U.S. equities are getting beat bloody year to date by pretty much anything else in the world. And that's a direct result of the concentration we've been talking about for the past couple of years. So we'll get started here in just a second. All right. Okay, perfect. Well, it's 2 minutes past the top of the hour. Good morning, everybody. Good Monday morning, specifically. Serge Berger here from thesteadytrader.com. I hope everyone's doing well. We are doing our Set the Market morning show here this week, Monday through Thursday, as usual. So you'll be able to tune in every morning, Monday through Thursday. I do have my notepad ready to get the week started. I hope you do too. And I would say without any further ado, let's get started. Again, as I always like to say, please make sure that you do subscribe to our channel. It's very important so that you get updated in real time when we go live. There's a lot of stuff going on in this market. There's a lot of stuff that I think a lot of people are ignorant to right now or don't want to hear. Because it goes against their positioning, which I want to talk about in a minute. Also, please make sure you give us a thumbs up like in the video. That helps us to be able to continue to do the show. If we don't get enough of those, we'll unfortunately have to stop doing the show at some point. And of course, we don't want that because we do enjoy doing the show and we think it's adding a lot of value for a lot of people. So, having said that, here are the top few things on my calendar. I do want to go a little bit deeper on gold and silver this morning. I think a lot of people are still not allocated to that trade and hence are wishing they were and waiting for pullbacks. Then we do need to talk about the dollar index quickly before we get anywhere. That's actually the starting point. And then we'll look at some individual stocks, including AVGO. We'll look at AR, another ticker symbol, and a couple more that we will then also continue to look at in the over in our chat room in the members area in a few minutes. Let me just quickly get to the first things first, and that is more or less where we left off last week on Thursday with the dollar index. Now, this is the trade-weighted dollar index chart, and it's important, right? So if you're sitting right now in your chair and you're saying, Serge, I only care about chart chasing breakouts in tech stocks, I don't care about this big picture stuff, then I would say to you, maybe you should stop trading because the no thinking, linear line drawing business that has worked so well for 10 years, it's probably over. And those people that continue to do that are probably going to lose a lot of money going forward. So why is this chart important? I want to quickly reiterate why we think it's important. Again, we talked about this last Thursday here. We talked about the dollar topping for several months, but this is, I think, a really, really good chart. So what this shows us is a trade-weighted U.S. dollar index. You can see it's only 3 times since the 1920s reached these levels of overbought. And of course, what it tells us in many ways is that most of, or a great deal of the global liquid equity and investments has gone into dollars. It tells us other things as well, but that's one of the main things it says. And so, of course, since that has happened, the U.S. dollar index has, of course, come off materially. So we're just going to go back to the regular dollar index. So this is what the dollar index looks like. I'm going to make it a bit prettier for you. And it's very possible that we've put in a significant lower high here, more in intermediate terms. And this is, of course, being directly reflected in the very same few stocks that have done so well and have lifted most 60/40, U.S. IRAs and 401ks over the past 10 years. When those flows reverse, and there's a lot of politics here in motion, a lot of the policies by the Trump administration, I think they mean well. I personally think, and this is, I don't do politics, but I think from a business perspective, they make a lot of sense. But it may not be something that's immediately going to cause your Nvidia stock to skyhook back to fresh all-time highs. And it's a problem because a lot of people we speak with, and I keep reiterating this because I see a lot of people still not wanting to hear it because they're in those positions. A lot of people are in Max 7s. If you go look at your retirement account, if you're a U.S. person particularly, you for the most part are exposed to Max 7s. Not a little bit, but a lot. Oh, but Serge, I don't know have any Microsoft and Nvidia. Are you basically net long the S&P 500? If you are, and there's a very, very high chance you're exposed to Max 7 way more than you think you will. And if the Max 7 stop going higher for a while, they've rallied like crazy. A lot of forward demand being priced in, not bad companies, but crowded stocks. There's a very big difference, right? I'm not fundamentally bearish on those companies. And so the capital's moving elsewhere, and the dollar is showing us this. And again, I would encourage everyone to really be thinking about this, what this means for I can't give you advice here. We can only do that over at Blue Marlin Advisor. If you want to go to bluemarlinadvisor.com, we're happy to talk to you about your portfolio. But I think there's a lot more international exposure that people need to put into their portfolios. But Serge, only U.S. stocks work. That's been true for the past 10 to 15 years. But if you dial back the clock and expand your horizon a little bit, you will see that that's absolutely not true. There's a lot of periods when European stocks beat the living daylights out of U.S. stocks for years, right? For example, or LATAM stocks or Asian stocks. And so if we're stuck in names that have had the highest market cap concentration ever in a few names versus relative to the S&P, that can exacerbate even more, right? So particularly if you're retired or thinking about being retired, and again, it's not investment advice here, it's only educational. You might be in a situation where you do not want to admit to yourself that that's what's happening. We see this, every day. So this is not storytelling. I see this. I'm just making sure, people kind of have something to think about. So that's number one. Now, a performance update quickly before we go look at some single name tickers here's what the year looks like. So you can see Germany up 22% on the year. You can see, actually I didn't add Chinese stocks in here, but let me quickly do that here. So basically almost anything, one could have bought almost anything this year and be beating the S&P 500, right? Except maybe the Nikkei, which is not doing well. Okay, but outside of that, most things are certainly beating the tech sector, right? Let's put it this way. And that's the problem, right? That's where a lot of people are stuck and they're not willing to get out because they have so much gains in their portfolio. They're not willing to get out. So that's where we use our repeatable process. We use our market rover. We use our repeatable process to make sure we have a sense of it. So now let's look at one stock that I'm going to quickly go through. This should get everyone's attention, particularly people that don't really care about all this important stuff, but just want a ticker symbol so they can start punching out a trade and then go to work. And sadly, there's a lot of people like that out there still. But here is a company called Broadcom, and the ticker symbol is AVGO. I'm sure plenty of you have probably heard of it. And let's just go through an exercise here. And this one looks good. Actually, it's a decent company. It's a very good company, I should say. And so this is a stock that a lot of people actually chased in December after they broke higher. There was a lot of people on Twitter calling everyone morons for not having bought it earlier. Of course, they themselves only bought it upon the breakout. And now the stock has completely reversed. In fact, since the breakout in December, the stock was down as much as 30%, and now it has found some pretty good support. So now you might say to yourself, this is an interesting setup on the long side, and I wouldn't disagree. In fact, I think it might be for a trade. But the stock is down 30%, and the semiconductor stocks as a sector, our market rover has some much more concerning signs on it. is showing a lot more weakness. There's a lot more things that are broken now. Not bad companies, but crowded stocks. Very, very big difference. Again, that's the kind of stuff that technologists that will tell you that AI is amazing and everything, and it is, right? They don't think about the crowding of positioning, which is ultimately what moves markets, right? I've had a lot of people write me hate mail about saying, Serge, what on NVIDIA, blah, 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 it's going to go to the moon. Fundamentally, I wouldn't disagree. I can't disagree. Where I can disagree is on the crowding of the positioning, which a lot of people don't focus on. And that's why you see, European stocks doing so well. We think that's going to be a multi-year story. Maybe LATAM stocks and again, maybe parts of Asia, including China. So let's look at Avago or AVGO. And again, we've got a pretty specific level here to trade against. Again, this is more of a trade than an investment for now. But what do you think will happen? The people that chased the breakout in December, and the Twitter sphere is full of it, right? Go here on YouTube, go type in Avago. I'm sure there's a bunch of guys sitting around in their underwear, preaching about stocks, talking on YouTube, talking about the breakout in Avago, and it was a good breakout. The problem is the stock since then, again, is down 30%, and it's been steadily down. At some point, people start to get nervous. So what's going to happen, right? So what's going to start to happen at some point here is you might get a bounce because the broader market may be near term oversold, right? So maybe that's going to bounce here. Now, what do you think is going to happen to some of those people once they get their money back, right? Or some of the money back? They can say, "Oh man, that was good, close call. I'm going to get out," right? And the CapEx cycle is actually slowing down. And again, you have to think about what this means. What you need to watch is this. There's so much money, guys, you've got to understand there's so much money stuck. Stuck is the wrong terms for now. Let me rephrase. Actually, no, mentally stuck in these huge few names, and Avago is one of them. Not bad companies, but crowded stocks, right? Stocks that are crowded to this nature can easily correct 50, 60% and still be great companies. People don't want to hear that because they're in those names. Their entire net worth is in those names by now. And so I just really would consider people to think about what this could mean for you going forward. If the S&P doesn't continue to just V-shape reversal higher because some guy on TV that they reel out every day when the S&P is up or down 1%, and you know who I'm talking about, he's been bullish and will always be bullish because that's his thing. And there's nothing wrong with that, except that people don't really like to hold stocks that draw down 50%. And there's a lot of stocks, by the way, this year that are down big that everyone was chart chasing and talking a lot about in December and January, right? And so a stock like Avago is incredibly crowded. Steve is asking, is it even crowded at 30% down? Steve, the stock is back to now where it was in December. It's nothing. That's absolutely nothing. What we have seen is a linear bull market in 10, 12 stocks, right? And so at some point, that linear bull market is going to take a pause. And 30% down is not much for a stock like this. Talk to me when they're down 50 or 60%. Not because they're bad companies. They're not bad companies. I want to continue to reiterate that, right? But you're seeing the capital, and I talk to pension funds and high net worth individual every single day, and they're telling me they are rotating. They have been rotating out of these mega cap stocks into pretty much anywhere else. A lot of commodities, material stocks, gold, international stocks, which really no one gives a hoot about until it's kind of too late, until those things have actually already rallied a bit too much. Okay, so that's kind of where we are right now in these stocks. So I know it's difficult to get people to think differently because these are very confusing times to a lot of people who didn't have to think much. They drew lines very, very much like I'm doing. I'm drawing two lines and calling that analysis. It's a bit pathetic, right? What we really need to do is take things like this into account and see where the flows are going. So that's number one. Well, that's, I guess, two things. The second thing, I want to go a little bit deeper on gold. And in order to do that, we are going to look at a long-term chart of gold. And I would like to share with you what the longer-term trajectory and potential price targets are on something like gold. And I did this for members only, actually, in a video yesterday, so I don't want to give too much of it away. but I do want to give you a basic idea of it for everyone that's here. And if you find value, of course, you might join us behind the paywall so we can actually go through this in more detail and hopefully make it really work for you. So here is a couple of sort of big moves that have happened in gold. And I'm going to put this into a bit of context so you can see how much further gold may be able to go in this current cycle. Okay, so I'm just going to go back, back to the 1970s for now. I could go back further, but in the interest of time, let's just do that. So we had a big breakout in basically 1978 that led the price of gold to rally about, let's call it 300%. Okay. So that's 300% here. I'm just going to quickly type this in so everyone can see, because I think very much like people are right now not interested in international stocks yet. They're now waking up to gold when it's up 50%, right, or more. It's actually up even more than that. So that's 300%. Then we had a big rally that basically took place from January 06 into 2011. That was 280%. So let's make that 280%. So 280. Okay. And so far, the current rally, that's also coming out of a 12-year base, is so far about 50%. Okay, so far, it's 50%. Now, given the fact that we have central banks that are actually, selling dollars and buying gold, I would not be shocked if gold ultimately rallies at least, let's say, 200%. Well, if gold rallies 200% from here, from the beginning, which is already up 50, right? If it makes it a total of 200%, which of course is 100% short of or at least 100, or at least 80% short of these other ones, rallies, then a 200% rally would get gold to, let's call it, not between 5,000 and 6,000. Okay, maybe closer to 6,000 than 5,000. And again, people not interested. We see that institutional investors are getting more interested now that it's up big. And it's going to be the same thing we think in a lot of these international and European stocks. So if you are not yet diversified, and most probably aren't, again, not recommendations here, just educationally, it's typically good to understand what these capital flows look like in the bigger sense. Silver is probably a good catch-up trade. I think silver can go a lot higher. Currently, silver, if we look at the futures contract, which gives us an idea of kind of what this looks like, it looks very constructive. This is the long-term monthly chart. We can make it a weekly chart and see it a bit more like this, right? So here too, we've got, if we can maybe look at like this, a potential catch-up trade that could be epic in proportions, and silver could easily go somewhere into the mid 40s from that. That's a big move, right? So even if, let's say, silver just goes to 40, right? That's a 22% move. If it goes into mid 40s, that's 36%, potentially a lot higher. So these are some of the things on top of our mind. I'm gonna stop it here right now. We've gone pretty heavy here for 15 minutes. Probably a lot to comprehend. If you guys have any questions, please do let us know. We'd love to hear from you. We'd love to have some feedback as well. Of course, as always, we'll see you guys over in the members chat room in just a few minutes. And it's going to be a busy week as usual. So look forward to being with you guys here all week. Again, I hope this is helpful. If you guys have any questions, if you want to support at thestudytrader.com, if you need help with a portfolio, again, I can't give you advice here. Please go to bluemarlinadvisor.com. That's our investment advisory firm. Otherwise, obviously, educationally, go to thestudytrader.com. Again, as always, hope it's helpful. I really encourage people to take these times serious. If you're looking to blindly buy dips on things that are down 5, 10, 15, 20, 30%, I think it's a different time. We're not calling for stock market crashes, by the way. That's a very big difference, right? We're not calling for stock market crashes. What we're calling for is a very different situation. And I hope people are waking up to it. I think a lot of people are not yet, but I'm hoping people will. So I'm happy to talk to you guys on that as well if you want to reach out to us. Have a great week. Hope it was helpful. Thumbs up. Please subscribe. We'll see you back here tomorrow morning. And all of you guys that are members will see you over in the chat rooms in about 10 minutes. Thanks for being here and have a good week.